Imagine owning a piece of the Empire State Building or 100 units across apartment complexes in Austin and Denver. You don't need $1 million to get there. Real estate has built more wealth than almost any other asset class, and now you can access it without ever fixing a leaky faucet, screening a tenant, or negotiating with a contractor at 7 in the morning. That's what we're talking about today. REITs, real estate investment trusts, and how they let you collect suit gain without becoming a landlord. By the end of this, you'll know exactly how they work, why they outperform regular real estate investing in certain ways, and the one strategy most people sleep on when they're first getting started. Here's how it all breaks down. A REIT is a company that owns, operates, or finances income-producing real estate. Think of it like a mutual fund, but instead of stocks, you're buying shares in a portfolio of buildings. The concept dates back to 1960 when President Dwight D. Eisenhower signed the Cigar Excise Tax Extension Act, which sounds boring, but it basically created the legal framework that made REITs possible. The first REIT, Medical Properties Trust, launched a few years later, and today there are roughly 240 publicly traded REITs operating in the United States alone, managing over $4 trillion in real estate assets. Here's the part that matters most for your wallet. To qualify as a REIT, a company must distribute at least 90% of its taxable income to shareholders as dividends every year. That means you're getting regular income just for holding shares. The average REIT dividend yield sits around 4 to 5%, compared to roughly 2% for stocks in the S&P 500. Now, there's a trade-off. REIT dividends are taxed as ordinary income, not qualified dividends, so the tax rate can be higher depending on your bracket. But here's the counterpoint. REITs have historically delivered strong total returns, and the dividend income alone makes them compelling for anyone building passive income streams. Let's talk about the three main REIT categories so you know what you're actually buying. Equity REITs are the most common type. These companies own physical properties, apartment buildings, office towers, shopping centers, warehouses, data centers, cell towers. They earn money the old-fashioned way. Tenants pay rent. About 90% of all REITs fall into this category. Then you have mortgage REITs, which don't own buildings at all. They finance real estate by buying or originating mortgages. They earn interest on those loans, which means their returns are tied to interest rates in a big way. When rates rise, mortgage REITs can get squeezed hard, which is exactly what happened in 2022 and 2023 when the Federal Reserve started its aggressive rate hiking cycle. The S&P REIT index dropped more than 25% in 2022, one of its worst years on record. If you owned mortgage REITs through that period, you felt that pain directly. That brings us to hybrid REITs, which do a little bit of both. They own properties and they originate mortgages. They're less common and offer a blended risk profile. Now, if you're thinking about buying individual REIT stocks, you need to understand what drives their performance. For equity REITs, it's simple: occupancy rates and rent growth. A REIT with 95% occupancy in a market where rents are climbing 4% annually is going to grow its revenue and dividends over time. Prologis is a great example. This industrial REIT owns warehouses and distribution centers across 19 countries. During the e-commerce boom of the late 2010s and into the pandemic, demand for warehouse space exploded. Prologis' stock roughly quadrupled between 2015 and 2020. Its dividend grew by over 60% during that same window. On the flip side, office REITs have struggled badly since the pandemic. Vornado Realty Trust, which owns high-profile properties in Manhattan, saw its stock crater by more than 60% from its pre-pandemic peak. Remote work hollowed out demand for urban office space, and many analysts still aren't sure office occupancy will ever fully recover to 2019 levels. That divide, industrial REITs winning, office REITs losing, is why sector selection matters enormously with individual REITs. And here's where I want you to really pay attention. If you don't want to pick individual REITs, there's an even easier path that still captures most of the upside. Index funds. Vanguard offers the Vanguard Real Estate ETF, which trades under the ticker VNQ. It holds a diversified basket of roughly 160 REITs across all sectors. The expense ratio is just 0.12%, which means you're paying $12 per year for every $10,000 invested. Over the long run, VNQ has delivered roughly 8 to 10% annualized return since its inception in 2004, which handily beats most bonds and competes closely with the broader stock market. For most people, buying VNQ and forgetting about it for 20 years is a perfectly reasonable strategy. You get instant diversification, professional management baked into each underlying REIT, and the steady dividend income flowing straight into your account. But, and this is the part most people miss, there's a layer most investors skip entirely. I'm talking about dividend reinvestment. By default, most brokerage accounts let you enroll in a dividend reinvestment plan which takes those quarterly dividend payments and automatically buys more shares instead of depositing cash to your account. At 4 to 5% dividend yield, reinvesting those payments for 20 years in a REIT index fund can dramatically accelerate your compounding. A 2019 Dalbar study found that the average equity investor earns about 5% annually because they buy high and sell low during volatility. Dividend reinvestment fights that instinct by keeping you fully invested every single quarter, no matter what the market is doing. It's boring. It works. Here's the second layer most people overlook: tax-advantaged accounts. If you're investing in a REIT index fund inside a Roth IRA, you pay zero taxes on those dividends, ever. The money grows completely tax-free and comes out tax-free in retirement. Even inside a traditional 401k or IRA, you defer taxes on REIT dividends until withdrawal. For high earners in the 24% bracket or above, that's a meaningful benefit. Compare that to holding REITs in a taxable brokerage account where you're on the hook for ordinary income tax rates on those dividends every single year. The math compounds in favor of tax-advantaged accounts in a big way over decades. So here's where I want you to land on this. REITs give you real estate income without becoming a landlord. The easiest on-ramp is a low-cost REIT index fund like VNQ. The highest impact move you can make is enrolling in dividend reinvestment inside a tax-advantaged account. The combination of regular dividend income, long-term capital appreciation, and tax efficiency through a Roth IRA is one of the most powerful passive income engines available to everyday investors. You don't need to pick individual REITs. You don't need to manage properties. You don't even need a fortune. You can start with $50 a month in a brokerage account that offers fractional shares. The barrier to entry is essentially gone. The question is whether you're going to use it. If this video made you think about real estate investing differently, give it a thumbs up. Hit subscribe if you want more videos like this breaking down how money actually works. And if you know someone who's been curious about REITs or frustrated by the complexity of buying rental property, share this with them. It might be exactly the push they needed. I'll see you in the next one.